Are you an aspiring entrepreneur looking to start your own company? Or maybe you've recently launched your business but find yourself perplexed by the complexities of finance and accounting. Don't worry, you're not alone. Understanding financial terms like balance sheet, turnover, revenue, and more can be daunting, but fear not. In this video, we'll demystify these terms and provide you with the clarity you need to navigate the financial landscape of your business. First things first, let's tackle the balance sheet. As a business owner, the balance sheet is a vital tool that provides a snapshot of your company's financial health at a given point in time. It lists your company's assets, liabilities, and equity. But what does it all mean? How do you read and interpret a balance sheet effectively? Stay tuned, and we'll break it down step by step. Whether you're starting a new venture or have already begun, understanding financial terms is crucial to making informed decisions about your business's future. We'll take you through each term, explaining them in simple language and providing relatable examples along the way. By the end of this video, you'll have a solid grasp on concepts like turnover, revenue, gross income, net income, cash flow, and more. But it's not just about knowing the definitions. We'll also guide you on how to calculate and interpret these financial figures in a meaningful way. From understanding your company's revenue streams to analyzing profitability, we'll equip you with the tools and knowledge to confidently assess the financial performance of your business. Next one, we have turnover. Turnover refers to the total sales or revenue generated by a company within a specific period. Imagine our lamp company made £100,000 in sales in 1 year. That £100,000 would be our turnover. Next, we have revenue. Revenue is the income a company generates from its main business activities. In our lamp company, revenue comes from the sales of lamps. If the company sells 500 lamps at £200 each, the revenue would be £100,000. Moving on to gross income, also known as gross revenue. Gross income is the total revenue generated by a company before deducting any expenses. Let's say our lamp company has total revenue of £100,000. However, it has expenses such as the cost of lamps, packaging, and shipping, which amount to £30,000. In this case, our gross income would be £100,000 minus £30,000, equaling £70,000. Now let's look at net income. Net income is the profit a company earns after deducting all expenses, including operating expenses, taxes, and interest. Assuming our lamp company has additional expenses of £20,000, our net income would be £70,000, gross income, minus £20,000, additional expenses, giving us a net income of £50,000. Moving on to gross profit. Gross profit is the difference between revenue and the cost of goods sold, COGS. In our lamp company, if the cost of producing the lamps was £40,000, the gross profit would be £100,000 revenue minus £40,000 COGS, resulting in a gross profit of £60,000. Next up is net profit. Net profit is the final amount of money a company earns after deducting all expenses, including operating expenses, taxes, and interest. In our lamp company, if we subtract the additional expenses of £20,000 from the gross profit of £60,000, we get a net profit of £40,000. Now let's talk about cash flow. Cash flow represents the movement of money in and out of a company. It shows how much cash is coming into the business and how much is going out. For example, if our lamp company receives £70,000 from lamp sales but pays £50,000 for expenses, the cash flow would be positive, indicating a net cash inflow of £20,000. Moving on to equity. Equity represents the ownership interest in a company. It is calculated by subtracting total liabilities from total assets. Suppose our lamp company has £200,000 in assets, such as inventory, equipment, and cash, and £150,000 in liabilities, including loans and accounts payable. The equity would be £200,000 assets minus £150,000 liabilities, resulting in £50,000. Finally, we have the balance sheet. A balance sheet is a financial statement that summarizes a company's assets, liabilities, and equity at a specific point in time. It provides a snapshot of the company's financial health. Our lamp company's balance sheet would show £200,000 in assets, £150,000 in liabilities, and £50,000 in equity. Now let's dig a little deeper into assets. Assets are resources owned by a company that have economic value and can be used to generate future benefits. In the case of our lamp company, assets could include the inventory of lamps, cash in the bank, equipment, and any other tangible or intangible resources that hold value. On the other hand, liabilities represent the company's financial obligations or debts. These are the amounts owed to external parties such as suppliers, lenders, or creditors. In our lamp company, liabilities might include loans taken to finance the business, accounts payable to suppliers, or any other outstanding debts. Now, let's talk about shares. Shares represent ownership units in a company. When a company is formed, its ownership is divided into shares, which are typically represented by stock certificates. In our lamp company, if there are 1,000 shares and you own 100 shares, you would have a 10% ownership stake in the company. Understanding these financial terms is crucial for evaluating the financial health and performance of a company, such as our lamp company. It allows business owners, investors, and stakeholders to make informed decisions and assess the company's profitability, cash flow, and overall value. I hope you found this video helpful and informative. If you have any questions or would like us to cover more topics related to finance or business, please let us know in the comments below. Don't forget to like this video and subscribe to our channel for supporting us and for more content like this. Thanks for watching, and we'll see you next time.